Hi everyone, welcome back to the podcast. It's me and Arun here today. Good morning and Monday morning, start of the week. I hope you have a very productive week. It's the last few days of Feb. Let's make it good. So Arun, what do you have today?
Sir, I have comments from videos of our channel. So the first comment is, Sir, I could save around 10k per month and I have emergency gold as well. Now I should consider SIP on index fund or value stock. Could you please suggest me?
Okay. Still, I know he has said he has got gold, but he has not answered the other questions. Other questions is, I need to know, does he have insurance? Right? Insurance is one. Then does he have any loans?
Monthly income also.
No, monthly income also, let's say out of monthly income, he's only taking 10. Okay, so he's able to pull 10 out. Because he's got gold, I'm assuming he's been a good boy and he's got gold and he's got insurance and he doesn't have any loans. Right? So then, second thing I need to know after all this is cleared is, what is his age and what are his goals? Right? So let's say he's only like 27 years old and he doesn't need this money, what he's going to be putting. When he's only 60, he needs it when he retires, let's say. That's good 23 years. Then I'll say, start putting in stocks.
Okay.
Especially the kind of stocks Anand is asking you to consider. Those stocks will look fabulous 20 years from now. If you have an ITC, 20 years from now, the ITC might be 2,000, 3,000 or even more.
So that will give more returns.
Correct. So if you're slowly accumulating ITC, the dividends, the bonuses, everything will come into play for you.
Okay.
Right. Now let's say his runway, he's not 27 years old. Let's say he is 40 years old and he needs this money by the age of 50, 55.
So yes,
only 10 to 15 years. Right, because let's say his child will be getting married or something. There's a very specific thing he's investing for. Then I will say put it into passive fund, index fund. Because the reason is the index fund, if it's a goal which is a very set timeline, right? Then I would suggest staying in mutual funds for the simple reason, when the time comes, the date when you need that money, you need to pull it out. In stocks, you may not be able to pull it on that day because that specific stock which you have bought will correct. So the risk is higher when you look at it like that. Of course, mutual funds can also correct, but that's some risk which you have to take. Yes. So the mutual funds might correct 5%, 6%, worst case in a single day, while stocks can correct severely on a single day. Some bad news comes about. You know, you've been watching your ITC go from 400 all the way to 800. Suddenly some bad news has come, some fraud or something, and it goes from 800 comes to 600. You feel terrible. Because you've been banking on that.
You will calculate based on that 800 rupees profit.
Correct. And you're calculating all this date, you're going to encash it on that day. So, if you have a specific date, you need to take the money out and a specific amount you need, then stick in passive funds.
Okay.
If you're putting for long term, I don't care. When I retire only, I need it. I want maximum growth and I want maximum returns. Then put it in value stocks, which Anand is asking you to consider.
Okay.
Next one.
Sir, the next question is, Sir, talk about surveillance measure for South Indian Bank. What does that mean?
Surveillance measure is the stock market controllers, which is the BSE and NSE, are looking at a stock specifically. They're putting it under the lens, meaning they're tracking all the transactions. They're not saying anything bad about the stock. They just want to make sure there are no transactions which are looking iffy. Iffy means, let's say you have a toll gate and you're collecting every day 1,000 rupees. Suddenly you see a spike of 10,000 rupees, you'll be wondering what happened. But suddenly from 1,000 you see a dip of 800 rupees, 700 rupees. As the owner of the toll gate, you'll be wondering what is happening.
Okay.
So it's like that. They want to see the trade volumes, the trade prices for a short period of time. They're keeping an eye on it. Now, what happens is, because of this, if you're a trader, your margin cost might become higher. Okay. But we are value investors. So it really doesn't affect us. Short-term traders, it will impact them. This kind of ASM. Then you have different grades, stage 1, stage 2, stage 3. Depending on it being needed, they may raise it and they might even make it longer. So right now, it's nothing to worry about. They just want to keep an eye on that stock.
So that doesn't mean that the stock has a bad news and all?
Not necessarily. It can. Right? I'm not saying it won't have. I don't see any reason to worry about South Indian Bank.
Okay.
I'm sure if you go read the circular why BSE has done this, there will be more details in it. So you can go to the BSE's website and read more about it.
Okay.
Me personally, I'm a value investor. So if I'm looking at it in terms of value investing, this really doesn't bother me. Right? I'm not trading. I'm going to buy it.
This will last for around 3 to 4 months. And after that,
yes.
good news will be there.
There's no bad news in this. Right? It's just keeping an eye. right? Like keeping an eye on anybody to make sure there's nothing fishy going on. Which as an investor is also good for you.
Okay.
Because if they're keeping an eye means they're keeping an eye out for everybody. So if you're not doing anything wrong, you don't have to worry about it.
Okay.
So should you be cautious on value investing in the long term? No. And there's no fundamental change in the business. So then, and we're investing only in Tiffin coffee range.
Okay.
So our exposures are also at minimum. So I won't worry about it. Now, flip of it, if you're a trader, then you'll have to consider.
Yeah.
Because I do not do trading, nor do I advise on trading. So how the margin cost increases and all that other variabilities and other risks in trading, you will have to check. Because I do not do that. So I don't know about it. I hope that helps.
So the next question is, if yen is weakened, it's good for Japanese economy.
But the yen becomes weak, yes, it's good for Japanese economy.
But if Indian rupee weakens, it's bad for Indian economy. Why is that?
No. See, there's a big confusion. Yen becoming weak, the Indian rupee becoming weak is good for both countries for certain sectors. Japanese export will become cheaper.
Oh.
Let's say a Toshiba laptop was costing $100 to come out of Japan. The yen has become weaker. That $100 laptop might become $90. Same thing is true for Indian pharma. What was exporting for $100 might come down to $90. The reverse is also true in the sense that the price will not go down, but the amount of money they make goes up. So the Japanese manufacturer might not lower the price because his cost has come down. He might still export at $100, but he's getting more yen for that. So that helps in making more money for the factory. So they'll reinvest that money in building better factory, upgrading the factory, whatever. It's more cash flow for the company. Same is true for Indian. That's why when the Indian becomes weak, Anand says always pay attention to all the companies which send products out of India, which is your pharma and IT are the biggest. So any company which is exporting and receiving payments in dollars, it's good when the rupee becomes weak. The same is true in reverse. Let's say the rupee becomes strong. Then these export companies, then income will go down. But companies which are importing into India and selling, like you're not iPhone anymore, India manufactures iPhones, but any other product. Let's say you're in an industry where you need to...
Medicines and all.
Yeah, medicines or there are certain special equipment which is brought into India and sold. Like during the pandemic, everyone was buying the Philips air machine, which pulls oxygen from the air and it gives oxygen concentrators. Those are all imported and being sold. So those prices will come down. So it's a seesaw. It depends on which side you're sitting on.
Okay.
So it can be good or bad. But in terms of the economy, it's always good if the country is exporting more than importing. That means the trade deficit of the country trade balance is in the positive side. So India will always like to send out more products than bringing in more products. India's biggest problem is oil and gold. Because of consumption of high amount of oil and gold, India is in trade deficit. That's why government has tried many schemes trying to discourage Indians from hoarding gold, saying there's nothing you need to keep so much gold for, let's reduce the gold. They're trying to encourage citizens will do what they wish.
Okay. So the next question is, sir, put a video on loan products and its loophole.
More of a request, we will do loans, products and the loopholes, how you can use loopholes and loan products. We'll do that. Cool. So look forward to that video, guys. Thanks for watching the podcast today. And I'm sorry, I have this habit of clicking the pen. I should try and keep it down. If you did hear it and it's disturbing, I'm sorry. I do apologize for it. I'll try and not keep the pen next to me when I'm recording videos. Thanks for watching the podcast and see you in the next one.
Thank you.